Welcome now, Josvi, who's the Director of Finance and CMD Additional Charge at Cochin Shipyard, joining in on the show right now. Mr. Jose, great to have you today on ET Now. Thank you so much for your time. I firstly want to begin with your order book, which is, and also your L1 bidding as well at 26,000 crore rupees against the aspiration of 3 to 4x turnover as order book. What's the realistic timeline to get there, and what needs to go right for you?
Yeah, good morning. Present order book is around 21,300 crores, which, as you rightly said, that it is not included that 5,000 crores which we have become L1 recently. So if that is also added to the order book, it will be around 26,300. Which we are thinking that it will be converted into an order by September this year.
Got your point. Give us a sense as to how execution plays out. It's a large order book size. What capacity are you currently sitting on? Are you growing capacity? What's the execution looking like? How many years will this order book take to execute? On a very patchy line, sir. We're going to try to patch you back, but basically 26 to 27,000 crore potential per se. Of course, Cochin Shipyard in focus also because of the OFS. That's one of the other reasons why Cochin is in focus. But broadly, you can see the clip. And if we can pull out the revenue clip as well, there you go. That's the margin clip in front of you. But if you can pull out the revenue clip as well, you'll get a sense as to how the numbers really stack up. I'm also trying to pull out to try and contextualize how the numbers are shaping up. 37,000 crore is the market cap of the company. The execution run rate is approximately 5,000 crore annually, at least at this point. Last couple of years, broadly in that range of 4,800 crore to 5,000 odd crore. Growth has been strong, but margins have weakened FY26. There's also a growing portion of the revenue which comes from repairs and maintenance, which is one, recurring, so therefore more stable, but also it gives a better platform to the execution in terms of revenue run rate. Broadly, that's how we stack up, but we'll get a better sense from Jose with regard to that. Can you hear me, sir? Am I audible? Okay. What we'll do is step into a short break, patch that line, fix it, come back and have that conversation. Stay with us. Welcome back. In conversation with Cochin Shipyard. Not an easy management to get because we don't get con calls either. But great having you here, Jose. Let me start off by trying to get a sense from you on execution run rate, right? The opportunity is large. How does execution play out for you? How are you building up on capacity? Maybe over the next 2 years, if you can give us that visibility.
Yeah, the execution, we normally guide around 12% growth year on year. And this year also we are targeting that and slightly more than that also. And as I said, the capacity wise, we have a lot of capacity has been unlocked after commissioning the 2 large projects. So the capacity wise, we are compared to other yards, we are okay with now. We can take some more orders.
Understood. The clip of order book growth is far stronger than execution. What do you think, or what's your sense on what's contributing to that kind of growth? Because at some point of time, execution will have to start catching up with the kind of growth that you're seeing on the order book side of things.
So the 2 Capex projects which was commissioned, though we commissioned last year, there were teething issues while it is common for all the new projects when it is commissioned. So that is being addressed now. And the vessels which we are building now, it is highly technologically oriented. So we faced some challenges in the technological execution also. So both are being addressed now. And this year we can see a reasonable growth compared to last year.
Right. The other thing I wanted to understand is that, you're guiding about 12 to 15% year-on-year growth. Does that already bake in the LPD projects of 32,000 crore rupees and the 40 to 50,000 crore rupee defense pipeline as well? Or is that purely organic from the current order book?
This is organic fully only from the current order book. Even if we get a LPD or the other large projects, to get into convert into turnover, it may take another 18 to 20 months to start recognizing turnover, because it's a long gestation projects. So once we sign the contract, it will be in the design board for around 6 to 8 months. After that, the procurement lead time around 4 to 8 months. So normally, the turnover will be recognized starting from 18 to 20 months only. So whatever I'm saying is from the existing order book.
Understood. The other thing which investors would want to understand is on the defense and export commercial mix shift from 65-35 to now 50-50. Is this being driven by capacity constraints on defense, or a deliberate strategic push to de-risk revenue concentration?
See, always we want defense orders, because we want a large projects of defense always with us, so that it will take care of our overheads and other fixed expenses, and so that we can competitively bid for export and other commercial orders also. So we would like for any companies, and especially for Cochin Shipyard, a 50-50 mix will be a better always. And you, as you are aware, the shipbuilding industry is a cyclical industry. So even if the commercial shipbuilding go for a downward cycle, we can float around with the defense.
And what about ship repair? Because some very strong growth that you're penciling in. I believe the current contribution to top line is roughly 30% odd. It's at 1,500 crore in terms of top line contribution. It's expected to go to 2,500 crore in the next 2 to 3 years. How certain is that? That's my first question. Second, what's driving that kind of growth?
The ship repair, we are strategically planned, positioned geographically also. Now we have a Cochin facility. Then we have a ISRF facility that is exclusively dedicated for ship repair. Now we have facilities for Mumbai, Calcutta, and Andamans also. And we are also planning to set up a large ship repair facility in Wadina, Gujarat. So how we are planning to strategically position is that in ISRF, all the ships which is less than 130 meters length will be diverted to the ISRF facility. Here in Cochin and the other Mumbai, Calcutta, and Andaman unit will concentrate on ships exceeding 130 meters to 250 meters. And Wadinar, when it is commissioned, all the large ships will go to like from 200 meters and above will go to the Wadinar facility. This is how our strategically positioning our ship repair units. And there is a strong demand for ship repair in India. And currently also we are holding more than 45% market share in India. So we are very confident that in 3 years we can achieve 2,500 crores.
And are the margins significantly better in ship repair versus shipbuilding? How do the margins evolve? The margins fell, sir, in FY26. If you can give us a perspective on what caused that?
See, margin for ship repair is higher than the shipbuilding. And shipbuilding, as you are aware, even the defense orders, it is coming through the competitive bid. There won't be any nomination orders. So we cannot expect margins as we were getting in the defense orders. And ship repair, the margin, the EBITDA level, it's around 23 to 24%.
Right. The other thing I wanted to understand also is that you're pegging only a 25% win probability on the 40 to 50,000 crore rupee defense pipeline. Is that a conservative base case? And would you move that number meaningfully higher eventually?
That is only a mathematical number, because what I mentioned was in the LPD, there are 4 competitors in 4 yards. So I thought the probability of winning is 25%. That's what I meant.
And
the LPD though competitively we are much stronger in that field, but conservatively I'd say that since there are 4 bidders, the chance of winning is 25%.
Okay, understood. The other thing I wanted to also understand was about your exports, because, you know, that's where we're seeing a meaningful move. You've again guided for about 25 to 30% of your order book versus about 35% currently. Is that guidance range also conservative, or do you see export order flow genuinely moderating from here?
Like defense, I cannot tell you the pipelines of the export orders, because that comes through the reference, not through the bidding or anything. But we have strongly put our foot in the export market, especially in Europe. So a lot of inquiries are coming. So we are growing our export order size also in our order book. And
What is
as you are aware, Udupi Cochin Shipyard, which is our 100% only one subsidiary company, they are having a export order of around 1,700 crores from Europe as of today.
and what is causing that traction? If you can give us a sense. And are these footholds that you're building in terms of relationships, Europe or otherwise, pretty much permanent? So do you expect a decadal kind of relationships with some of these players?
Yeah, surely, because all the relationship with our export clients are long term only. It started from 2008 when the oil market was high, but when the oil went down, because we were concentrating on those times in PSVs. So now we are building relationship other owners also, and coupled with the government of India announced incentives and SBFA, we can attract more export orders, not only for Cochin Shipyard, any shipyards in India.
Could you give us a sense on what the margins are for ship repair, shipbuilding domestic, and shipbuilding export? I know you can't talk defense, but if you can just give us some color around what the margins for each of these could be.
I can tell you that in shipbuilding, the margin is around 10 to 12%, but it's a volume game. The value of the orders will be very high. Whereas ship repair, the value will be less, the margin is higher, maybe around, you can say 22 to 24%. This is the overall guidance I can tell you.
And are exports materially better in terms of margins, in terms of the margin picture you get there?
May not be almost on the same side, same range.
Understood.
10 to 12%.
And how competitive are we versus some of the global players? Are we knocking on competition's door?
Yeah, see, we are not directly in competition with China, where we cannot compete because we are not there in the large merchant ship building, because there we cannot head on with China. So we are specializing in mid-size vessels and specialized vessels. There our competency is more, and we cannot we did not take the Chinese competition on direct hit. So we are concentrating on the mid-size and specialized vessels. There the margin is high, and technologically it's complex.
Understood. And what's caused this shift? Earlier, Cochin Ship only used to deal with domestic, if I'm not wrong. What's caused and what's the reason why we've been able to get a foothold in the export market?
So we were in the export market since 2008, but
Correct.
all
You
those
said
vessels were in the oil segment. So when the oil went down, that market also went down.
Understood.
Already we have exported more than 52 ships already, and presently around 32 ships are under order for exports, and which is under various stages of construction.
Understood. You know, this 12 to 15% kind of growth guidance that you've given us 12, but broadly it's the 12 to 15% kind of range. Do you believe that you can hit the 15% number for the next 2 to 3 years, just given the fact that you've got a very solid order book, and therefore the execution run rate is more in your control? Would that be the correct understanding if I were to infer that?
Yeah. In a couple of years, we can hit the target of 15 also.
Understood. And how is Capex coming along? If you can give us a sense as to how much Capex you're doing. You have an around 800 crore kind of EBITDA run rate annualized. How are you doing your Capex? In what phases is your Capex going to come on stream? And the impact of that on revenue, if you can give us a sense with regard to timelines and quantum?
Yeah, see, whatever capex which have already done, the large capex of 3,000 crores, which has been done with internal resources, we didn't borrow that. So now going forward, any capex which we are going to take will be on a debt equity combination. And the immediate capex which we are planning is that Vadinar project, that is around 1,570 crores. Out of that, our share is only 920 crores. The remaining is to be put in by the Deen Dayal Port. And putting together other various other projects also, the capex which we are planning to the next 3 years is around 2,500 crores, and over a period of 5 years it will be around 6,500 crores. And as you said, we are making a PAT of around 800 crores every year. So we are planning to give a 50% of the PAT as dividend to the investors. The remaining 50 will be used for the Capex internal resources, and the remaining will be borrowed.
That's approximately 1% of current MCAP for viewer perspective. Last piece, I'm trying to understand as to how defense plays an important role or a larger role. Of course, the entire Make in India initiative is one part, but talk to us about how defense margins are. My understanding is defense margins are materially better than the 10 to 12% you make on shipbuilding. Do you believe that there could be a risk to defense margins in the medium term, if not the short term, just given Make in India?
Yeah, Make in India, apart from now, there is two aspects in the Make in India. One is the defense sector, other is the commercial market of demand aggregation, the requirement of ONGC, SCI, and oil companies. So there is a lot of pipelines in the both sector, and as you said, all from both these two sectors, all bids are under competitive basis. So margin will be less. We cannot expect higher margin than 10 to 12%. This is what we are expecting.
Okay. Thank you so much, sir, for coming in and giving us that perspective. Always very good chatting with you.
Thank you. Have
All
a nice
right.
day.
And I look forward to more conversations, sir. Thank you.